Welcome back to part 2 of our beginner's guide to crypto trading. In the previous video, we covered technical and fundamental analysis. You can find the link to that video in the description below. In this video, we'll be looking at trading strategies. Before we get started, it's important to remember that crypto trading carries risk, and there are no foolproof crypto trading strategies. However, by educating yourself and trading responsibly, you are more likely to achieve realistic trading goals. The word trading ultimately means buying and selling assets with the aim of making a profit. A trading strategy could include what tools and indicators you use, what triggers you to buy or sell, to minor details like what days you prefer to trade and days you won't trade at all. We will be covering 2 types of trading strategies: active and passive trading. What is active trading? Active trading strategies require more time and attention. They are active because they involve constant monitoring and frequent portfolio management. The first active trading strategy we're going to be looking at is day trading. Day trading is probably the most known trading strategy. This involves entering and exiting trades very quickly, mainly within the same day. These traders aim to capitalize on price movements during a single day. The term day trading comes from traditional markets where trading is open during a specific time period. In those markets, traders can't stay in a position for more than a day. They typically use price movements and technical analysis to create trading ideas. Day trading can be profitable. However, it can be quite demanding and could involve high risk. Therefore, this type of trading strategy is something best left for the most advanced traders. Next, we'll be talking about swing trading. Swing trading is a long-term strategy involving holding positions for longer than a day, but usually not longer than a few weeks or a month. Swing traders try to take advantage of the volatility that takes a few days or weeks to play out. These traders use a combination of technical and fundamental factors to create their trading strategy. Chart patterns and technical indicators can also play an essential role in swing trading. Swing trading could possibly be the most convenient active trading strategy for beginners. A benefit of swing trading is that trades take longer to play out, but they are short enough so that it's not too hard to keep track of a trade. This strategy gives traders more time to consider their decisions. Swing trading can be done with less haste and more rationality, since the trader has more time to consider their next step. The next active trading strategy we'll be covering is trend trading. Trend trading is also referred to as position trading. This strategy involves holding positions for more extended periods of time, usually at least a few months. Trend trading takes advantage of directional trends. Traders using this strategy may enter a long position in an uptrend and a short position in a downtrend. Trend trading typically uses fundamental analysis because it considers events that may take a long time to play out. These events are what trend traders take advantage of. When using this trading strategy, the trader assumes that the asset will keep moving in the direction of the trend. However, trend traders have to consider the possibility that the trend might change. Therefore, they may also use moving averages, technical indicators, and trend lines. Trend lines are diagonal lines drawn on a chart. They connect specific data points, making it easier for traders to visualize price movements and identify market trends. Up next, scalping. Scalping is one of the fastest trading strategies out there. This strategy doesn't take advantage of big moves or drawn-out trends. It's a strategy that focuses on exploiting small moves over and over again. Scalpers often open and close their positions in a matter of seconds. Scalping can be good if a trader finds a market insufficiency that happens repeatedly. Each time it happens, they can make small profits that add up over time. Scalping is an advanced trading strategy that isn't recommended for beginner traders due to its complexity. It requires a deep understanding of the mechanics of the market. Scalping is generally more suitable for large, experienced traders. The profit percentage tends to be smaller, so trading large positions makes more sense. What is passive trading? A passive strategy is a more hands-off approach where trading requires less time and attention. We will be looking at two passive trading strategies. The first one is buy and hold. This is a strategy where traders buy assets intending to hold those assets for a long time, regardless of market fluctuations. This strategy is typically used in long-term investment, where the idea is to get in the market without considering the time it will take to make a profit. The idea behind this strategy is that the trader has long-term conviction, and they believe that the asset will gain value over time. The buy and hold strategy is almost always based on fundamental analysis, and usually traders who choose this method won't concern themselves with technical indicators. This strategy also doesn't require the trader to monitor their assets' performance regularly. Some might not check their portfolio for years, while some might still look daily but not act on any market movemts. The hodl phenomenon could be compared to the buy and hold strategy. Cryptocurrencies are a risky and volatile asset class. While buying and holding Bitcoin is a well-known strategy, it's not foolproof. Additionally, the buy and hold strategy may not be suitable for all cryptocurrencies. The next passive trading strategy is index investing. Index investing allows for a more hands-off approach to investing in blockchain and cryptocurrencies. In this strategy, traders invest in a sector rather than investing only in a particular asset. Traders will invest in a diversified basket of digital assets. Let's take traditional finance as an example. Traders will choose an index fund, which is typically made up of stock and bonds. A trader investing in an index that includes multiple companies would own stock at all of those companies included in the index. The benefits of index investing are less time researching individual investment opportunities, less risk. By investing in a basket of assets, the risk is low if something goes wrong with one or two of those assets. It also costs less to invest. For example, the S&P 500 is one of the most well-known index funds. It is a stock market index tracking the performance of 500 large companies listed on the stock exchange in the US. This means that by putting your money in one fund, you are automatically exposed to the price movements of those 500 companies' stock, which, as you can imagine, is a good way to diversify and spread your risk. Creating the perfect trading strategy to suit your goals is not always easy. We mentioned some of the most common crypto trading strategies in this video, so hopefully you can see which one is best for you. To find out which strategy works best for you, follow and track your strategy without breaking your own trading strategy rules. It's also a good idea to note down your strategy's performance. You could also allocate different parts of your portfolio to other strategies, monitor the performance of each strategy, and stay on top of risk management. The more you learn about trading, the more you will adapt your strategy. Your trading strategy should constantly evolve as you build your knowledge. We hope you have learned something about trading strategies in this video. That's it from us for now. We'll be sure to create more videos to teach you about trading. See you next time.